The market is a punishing master. It grants opportunities unlike any other endeavor known to man. It offers fortunes, vast, unbelievable fortunes, to those who observe and act without fear. But the greatest profits are seldom kept. That is the bitter, brutal truth of speculation. The reason a man can be up $2 million on Tuesday and then spend the remainder of the week watching that fortune melt away to a meager 50,000. What happened? Did the market turn suddenly aggressive? Was the news terrible? Was it bad luck? No. It was worse than all of that. It was psychological addiction. The greatest enemy to keeping a massive win is not volatility. It is not some shadowy manipulator in the syndicate. It is the trader's own internal dialogue. It is the inability to pull the trigger and accept the gift the tape has offered. You see a profit. It is substantial, it is life-changing, it is bigger than you ever dreamed it could be. And yet the sheer size of the win warps the mind. You become convinced that because the profit is so large, it must run larger still. You refuse to believe the move is over. You look at your ledger, the profit is magnificent. Then the inevitable correction comes. It is a slight pullback, nothing major, but it takes back 10% of your winnings. The professional acts. The amateur rationalizes. The amateur, blinded by the sight of the previous peak, says, "I'll give it back just a little bit. It will return to the high, and then I shall sell." You have already lost control the moment you make that decision. You have surrendered the initiative to the market. You have stopped trading based on reality and begun trading based on memory. You have made the tragic decision to bet against your own capital. I have seen it countless times. I have lived it countless times. A man who held a fortune in his hands, only to let it dissipate through his own fingers, drop by agonizing drop. The feeling of watching a massive, guaranteed, life-altering profit evaporate by 50% in a single day because you couldn't pull the trigger is the single most agonizing defeat a speculator can suffer. You betrayed yourself. You allowed greed, wrapped in the cloak of expectation, to rob you blind. We must learn to master that impulse. We must learn the final, difficult lesson of speculation, knowing when to secure the vault. Before we dissect the mechanism of this failure, I must ask you for a moment of your time. This lesson is critical. It must reach those who are still making these painful mistakes. Subscribe now, like this video, and leave a comment. By doing that, you help more people see this message, and you let me know this work is not in vain. The tragic flaw of holding too long, which resulted in some of Livermore's most profound setbacks, underscores the high market penalty incurred when judgment falters. Fortunately, Edwin Lefebvre's 1923 classic, Reminiscences of a Stock Operator, serves as the definitive record of those painful lessons. This book is less a narrative and more a vital mental training ground, allowing the serious operator to internalize Livermore's costly mistakes vicariously, effectively mitigating the need to pay those fees firsthand. But to ensure the profound weight of this wisdom translates accurately across a century of market evolution, the Max Davidson Annotated edition is indispensable, providing the critical historical context necessary for the contemporary trader. A link to this essential edition is provided in the description below. Now let us discuss how men of substance allow themselves to be utterly ruined by their best opportunities. Principle 1. The anatomy of a psychological round trip, the 100% trap. The most common failure among speculators who have mastered the entry and the ride is the failure of the exit. This failure leads to what I call the psychological round trip. The market cycle is simple. The stock advances 100 points in your favor. You are elated. You are untouchable. You believe you possess a special insight into the workings of the universe. This 100-point gain is your high watermark. This number becomes fixed in your mind. Then, the market turns. It is temporary, you think. The stock drops from 100 points up to 80 points up. This is the moment of crisis. You should sell. You should secure the 80 points. But you look at the ledger and you see the loss of 20 points from the peak. This 20-point loss is a defeat for your ego. You refuse to sell the 80 points because you are psychologically committed to getting back the 20 points you just let slip away. You are no longer trading the market. You are trading your own vanity. The stock drops further. Now it is 40 points up. The situation is now critical. You still have a substantial gain, but the decline has been steep. Your objective has changed entirely. You are no longer seeking to maximize profit. Your new, pathetic objective is just to get back to break even on the psychological loss. Meaning, getting back up to the 80-point level you foolishly rejected earlier. You have allowed the memory of the 100-point peak to destroy your objective vision. The stock drops again, trading sideways, and finally pulls back to 10 points up. You finally liquidate the position, exhausted, frustrated, and psychologically broken. You have captured 10 points from a possible 100-point swing. The trade was a massive success, but the discipline was a catastrophic failure. You took a round trip emotionally and financially, only to return to a position barely above the point you started. This is not trading. This is emotional gambling. The profit must be secured when it is substantial. The moment you begin chasing a prior peak, you are doomed. The market never cares what price you could have sold at. Principle 2. The difference between patience and stagnant hope. The time decay of profit. There is a profound difference between the patience required to ride a proven, validated trend and the stagnant hope that anchors you to a position that has clearly signaled its termination. Patience is the virtue applied after the entry, when the market moves slowly but correctly, confirming your reading of the line of least resistance. Patience allows you to ignore the minor daily fluctuations and secure the major portion of the move. This is sound speculation. Stagnant hope is the vice applied at the peak. When the upward momentum dies, volume evaporates and the stock begins to distribute or turn sharply against you. Hope is a destructive quality on Wall Street. The market does not reward hopeful anticipation. It rewards cold, clinical observation. You must never confuse the two. A trend that stalls for months on end following a massive run is not demonstrating patience. It is demonstrating exhaustion. It is demonstrating that the heavy operators are quietly shedding their positions. Patience demands you hold until the evidence shifts. Hope demands you hold despite the evidence shifting. When the market has clearly signaled the party is over, when the major averages fail to confirm the individual advance, when volume dries up, when the tape acts poorly on good news, the time for patience has ended. The time for discipline has arrived. Discipline demands you secure the capital immediately. Do not confuse the memory of a successful trade with the reality of a dead trend. You must cut loose the memory and embrace the cash. Principle 3. The illusion of top-ticking, the greed penalty. Every amateur, every novice who approaches the ticker tape harbors the same childish fantasy, that he can capture the absolute peak penny of a major move. He wants the credit. He wants to boast that he sold precisely at the high. This desire to top-tick the market is not strategy. It is vanity. And vanity is the surest route to financial calamity. The professional aims to capture the bulk of the move, the middle 80%. He does not concern himself with the final 5 or 10%. He knows that attempting to extract that final meager fraction inevitably costs him the 20 or 30% of profit that precedes the reversal. The greed penalty is exacted the moment you decide that the vast fortune already secured is insufficient. When a stock has run 40 points in your favor and you are holding a substantial lot, the risks associated with holding for the 41st point are astronomical compared to the reward. The potential decline is 40 points. The potential gain is 1. The moment you start trading for pennies, you forfeit dollars. I learned through hard experience that you will never, ever sell at the exact top. The true top is only identifiable in the rearview mirror. Trying to capture it is an obsession that keeps you locked in the trade too long, exposing your secured capital to unnecessary danger. You must cultivate the willingness to exit gracefully, leaving a small margin of profit for the next fellow. That small margin of goodwill is the insurance policy that secures your principal. Do not be the greedy pig who insists on the absolute last crumb. Secure the feast, walk away clean, and let the market punish those who arrive late and leave last. 3. Principle 4. Treating profits as untouchable principle, the security rule. Speculation at its highest level is a rigorous form of defensive capital preservation. The critical psychological step that separates the winner from the loser is the mental conversion of paper profit into secured principal. The moment a trade becomes substantially profitable, when it has run far beyond your initial risk tolerance, you must mentally convert that profit into secured, untouchable capital. It is no longer a paper gain. It is real money in the bank. It is the war chest. If the stock then drops, say, 10% from the high, you must recognize what is actually happening. It is not a fluctuation. It is not a minor correction. It is the market reaching directly into your bank account and taking back secured funds. When you view the decline not as a dip in unrealized gains, but as the theft of established principal, your urgency to act increases tenfold. A professional trader must establish an inviolable, predefined exit point for every major winner, set far below the peak, but far above the entry. This point becomes the line of defense for the secured principal. If the market violates that line, it means the structure has failed and the reversal has begun. If you fail to sell, you are essentially opening the vault door and inviting the market to take its fill. Once profit is earned, the primary mission changes from maximization to protection. You must become ruthless in guarding this new principle. If you treat these gains as ephemeral, disposable ledger entries, you will let the market steal them back every time. Principle 5. Validation versus justification, the market signal. Why do speculators hold losing positions? Because they are unwilling to admit they were wrong. Why do they hold winning positions too long? Because they are unwilling to admit the market has changed its mind. In both cases, they are justifying their previous decision rather than validating their current position. A massive profit should only be held if the market continues to validate the move. What constitutes validation? It means the technical action must remain perfect. Higher highs must be made on appropriate volume. Corrections must be shallow and swiftly reversed. There must be no visible signs of distribution, no high-volume selling days, no severe failures to advance on good news. When the market sends signals, they are facts. Holding onto a declining position is justifying the original entry. You tell yourself, I was right at the beginning, therefore the move must continue. You ignore the current verifiable data because your emotional commitment to the original idea is too high. This is hubris. When the tape acts wrong, when the structure of the market visibly deteriorates, when the averages refuse to confirm, when your stock can no longer rally despite the overall momentum, the trader must act right, immediately, without argument. The moment the validation ends, the trade ends. There is no room for justification, no time for debate with the ticker tape. You must secure the win before the tape punishes your deafness. Principle 6. The weight of unsecured capital, scaling out discipline. When a trade reaches an outlier profit level, when the position represents a truly staggering sum of capital, the psychological dynamics fundamentally change. The largest single risk to the speculator is no longer the risk of loss, but the risk of reversal. The weight of that unsecured capital is paralyzing. You fear that if you sell, the stock will continue to advance and you will miss the final run. This is the greed trap. You fear that if you hold, the stock will reverse completely and you will lose the fortune. This is the fear trap. These two fears held in balance result in paralysis. The speculator does nothing, waiting for the market to make the decision for him. This is precisely why Livermore, implicitly or explicitly, advocates for scaling out of mega winners. When you are sitting on 100,000 shares that have advanced 50 points, sell half of the position. Liquidate 50,000 shares. What does this accomplish? First, you eliminate the massive psychological pressure. You have secured a substantial war chest. This cash is locked away, safe from the whims of the market. You can pay your bills, invest in real property, and live without worry. Second, the remaining 50,000 shares are now psychologically lighter. They are trading with house money, so to speak. If the market continues to run, you participate fully, capturing the major final advance. If the market collapses, you still keep the enormous profit you secured. Scaling out is the disciplined maneuver that converts paper anxiety into tangible, secured strength. It allows the remainder of your position to run without the debilitating, paralyzing fear of massive reversal. It is a defensive discipline that protects the mind as much as the money. Principle 7. Identifying the line of least resistance shift. A sustained, massive winning position is built upon a clear, structural upward path, the line of least resistance. The advance is not random, it is systematic. During the advance, the stock consistently finds support. It may pull back to the 10-day moving average or the 20-day, but it holds. This establishes the structural integrity of the trend. The key signal to exit a major profit is not merely a correction, but a structural shift in this line of least resistance. If a stock has been riding an established support line and suddenly it slices through that support, not on a small correction but on high, aggressive selling volume, the upward path is broken. The line of least resistance has shifted from upward to sideways, or more dangerously, downward. Holding past this pivotal point is not speculation, it is betting against market physics. You are relying on a miracle for the stock to immediately recover and re-establish the broken structure. When the heavy operators decide the stock is finished, they do not nibble. They distribute. They sell large blocks. This volume tells the story. You must identify the violation of the critical support level, the point where the trend structure failed. That is the time to liquidate the massive profit. You must exit before the new line of least resistance, the downside, gathers momentum. Do not try to catch a falling knife that has just shattered its own handle. Principle 8. The psychological cost of seeing $1 million become $500,000. Emotional deterioration. The trauma inflicted by losing a huge chunk of secured paper profit is perhaps the highest cost of holding too long. Imagine holding a position that gave you $1 million in paper gains only to watch half of that, $500,000, vanish because of your own inaction. The financial loss is clear, but the psychological impact is often catastrophic and long-lasting. When you suffer that defeat, you become tentative. You become fearful. You start doubting the core abilities that brought you the success in the first place. When the next clear, opportune entry signal appears on the tape, you hesitate. You are slow. You overanalyze. You remember the pain of the previous reversal. This fear causes you to miss the next major trend. You have lost not only the $500,000 in cash, but you have destroyed your confidence, which is the most valuable commodity a speculator possesses. I learned that protecting the mind was as important, perhaps more so, than protecting the money. By securing the profit, by locking in the $1 million, you maintain a positive psychological account. You reinforce discipline. You prove to yourself that you are a decisive operator, capable of accepting the market's gift. This confidence leads to sharper entries and more aggressive commitment in the next opportunity. A trader who has liquidated a major profit cleanly is ready immediately for the next move. A trader who has watched a fortune melt away is emotionally wounded and will trade poorly for months trying to recover his footing. Protect your mind. Secure the victory. Do not allow your past successes to become future liabilities. Principle 9, using time as the ultimate stop-loss, the calendar rule. The market does not operate under the mandate of speed. Sometimes trends simply stall. If a massive profit has been accrued, and the stock then stalls and trades sideways for an extended period, absorbing time without any further advance, this pattern in itself is a profound warning. It is the calendar rule of profit-taking. What does this stagnation signify? It means the momentum is dead. The aggressive buyers have retired. The stock has run so far and so fast that new speculative money is unwilling to enter at current prices. The sideways action is often a distribution phase. The heavy operators are not selling aggressively, which would cause a crash, but they are selling quietly, offloading their large blocks to the hopeful retail public who believe the stock is merely resting before its next ascent. This lack of participation, even without a deep correction, is a clear signal to take the profits and retire the position. Time is a relentless thief. Every day the stock fails to advance, the potential reversal becomes more likely. The cost of holding increases exponentially. The market is telling you without the drama of a crash, I am resting and my next movement might very well not be up. You must respect the time dimension. If your successful speculation begins to absorb weeks and months, merely treading water at the high price, liquidate it. The money is better deployed in a position that is actively running or resting safely in the bank waiting for the next clear opportunity. Principle 10. The single most important rule of successful speculation: always take profit when it's available. If I could etch one principle onto the mind of every speculator, it would be this: never, under any circumstances, allow a substantial profit to turn into a loss or even a meager gain. This is the ultimate discipline. This is the difference between temporary success and lasting fortune. When the market has been generous, when you have accurately forecast a major move and a substantial fortune sits before you on the ledger, accept the gift. The impulse to hold for just a little more for the final few dollars is the ultimate expression of disrespect for the market's generosity. It is the refusal to accept the reality that money is made by seizing clear opportunities, not by achieving impossible perfection. I speak from the experience of total ruin and impossible wealth. Every major setback I ever suffered, every great fortune I lost could have been mitigated, if not entirely avoided, had I simply exercised this rule. It is a failure of character, not intellect. The difference between a seven-figure profit and a break-even position is almost always the intervening period where the trader knew he should sell but did not. You must train yourself to view substantial profit as immediately secured capital. If the stock reverses, that capital is under attack. Do not be greedy, do not be vain, do not be paralyzed. When the move is mature and the profit is magnificent, the tape has offered you the only thing that truly matters in this game: liquidity at a magnificent price. Take the money. Walk away. This is not capitulation. It is professional judgment. The professional trader is not defined by how high his profits run on paper. He is defined by how securely he locks those profits away into his bank account. The market is always open for business. The opportunity to extract a major winning position, however, does not last forever. Those critical windows of liquidity at the high prices close swiftly and violently. You must resolve to trade defensively. The moment you have secured a significant fortune, your objective is no longer offense, it is defense. Prioritize the security of the capital over the fantasy of perfection. The goal is not to sell the absolute top penny. The goal is to maximize the amount of cash you can successfully carry away from the table. Secure the win. Protect the mind. This is how you build a lasting fortune. This is how you survive the speculation game. Trade with discipline. Trade with courage. But above all, trade with the wisdom to know when enough is enough. Do not let the market steal back what it has so generously given you. Prepare now for the next trend.